Andy Dunham is having some technical difficulties on his end, so we were trying to buy some time for Andy to get his computer figured out so he can log in. But I think we'll go ahead and start. I've got a little introduction to do, and then that might give him some time, and then we'll probably let Craig go first, and then hopefully Andy can figure it out. If not, we'll have him back at another time and record his part of the presentation. So as you're probably aware, tonight's Farminar topic is risk management for a diversified farm, and so we're gonna start things off with Craig Christensen from the USDA's Risk Management Agency, and he's going to talk about their insurance product, the Whole Farm Revenue Protection, and how that can help diversified farms mitigate the risks that they deal with. And if Andy Dunham from Grinnell Heritage Farm can figure out his internet connection, then he's going to join us, and he's got a presentation that's going to talk about what they do on their farm to withstand changes to pests, diseases, weather, and markets. They utilize a variety of mitigation methods, to manage risks on their farm. So before I let these guys take it away, though, I'm going to speak a little bit about PFI and our Farminar series. So this is part of our winter Farminar series. We've got another 9 topics coming up. These are all on Tuesday nights at 7 p.m. There are 2 in March that actually are on Fridays at noon. That's part of a 2-part series on perennial crops. That's March 10th and 17th. They're going to be on a Friday at noon. Otherwise, these are always Tuesday nights at 7 p.m. They're free, and we do record these and archive them if you'd like to watch them later. So a little bit about PFI. We started back in 1985 by a group of farmers who were interested in improving their profitability, efficiency, and stewardship. And today we're still focused on those issues, but are now made up of farmers from all enterprises, not just row crops, and farms from all sizes. And we also have a good chunk of our membership is friends of farmers who support our mission. And our mission at Practical Farmers of Iowa is strengthening farms and communities through farmer-led investigation and information sharing. And our values are welcoming everyone, creativity, collaboration, and community, viable farms now and for future generations, and stewardship and ecology. As a member-based organization, definitely want to encourage you to consider joining us. You can tap into our network of members, which includes access to our wonderful email discussion lists on a variety of different topics. You can get our newsletters, discounts to our events, the opportunity to participate in our research projects, and all of our programming. There's more information about joining Practical Farmers of Iowa on our website. Also on our website is a calendar of events, and we really have a lot going on. This is a screenshot I took today of our February calendar. There's a lot coming up, and in particular I wanted to highlight 2 big PFI events that are actually going to be held in the same location at the same time, Strawberry Point, Iowa on February 10th and 11th. One of them is led by Holistic Management International and is geared toward established fruit and vegetable growers called Advanced Financial Planning. And the other is our annual Beginning Farmer Retreat for beginning and aspiring farmers. And so the 2 groups are going to share meal time and networking time, but have workshops and activities separate from one another. Both of these are offered at a super reasonable price, and they have a limited capacity, so visit our website to get more information about these 2 workshops and get yourself registered to join us. So real quick, if you want to stay in touch with PFI's Farminars, please provide your email address there in the chat box. And because it's fun to see where folks are tuning in from, go ahead and let us know where you're at tonight. Also, if you didn't notice, on the bottom left corner of the screen, way down there, is a little poll that helps us keep a head count, keep track of how many people are in here. So if there are a few of you watching together, please use that poll to check the appropriate box. While our presenters are talking tonight, feel free to use the chat box to ask clarifying questions, but we do plan to save plenty of time at the end for all other questions. So definitely keep thinking of your questions and we'll get them answered. And finally, near the end of our Farminar tonight, I'm going to post a link to take a real quick survey about the Farminar. So take a quick minute after the presentation to give us some feedback and also to suggest topics that you want to hear about in the future. So this is when I had hoped to pass it over to Andy. It doesn't look like he's figured out his computer issue yet. So we're going to let Craig speak first. I'm going to pull up Craig's presentation and we're going to hear about whole farm revenue protection from Craig, and then if Andy gets in here, we'll let Andy go next. Does that sound all right, Craig?
Yeah, that works for me. Thanks.
All right, I'm pulling it up now, so whenever you see it, you feel free to take it away.
Sounds good. Thanks, Steve. Before it comes up, I'll just, like you said, I work for the Risk Management Agency. I am here in the St. Paul Regional Office, and I've been here a couple years. I've been working on whole farms since I've been here, so I'm still learning as I go as well. But it's amazing how much there is to this and how many questions come up. So I'll go through this, and at the end, hopefully I won't go too fast. I want to try to get through the basics and get to some examples, and then at the end, I'll probably get to the questions at the end. I don't know if I'll be able to keep up with the chat as well. I was supposed to have someone here to help me and tell me when the questions came up. But anyways, or Steve, you can interrupt me as well too. But all right, looks like it's up. So I will be talking about whole farm revenue protection. I usually refer to it as whole farm, save myself a few syllables. And I plan to go over just some basics about whole farm, a little general overview, and I'll talk about commodity diversification, how we define that, and what that means for whole farm. We'll look at the insured revenue and how that's determined, and look at loss payments and what triggers those. Then I just plan to go through a timeline, basically just bring up a few important dates related to the policy. And then at the end, I'm going to go through a couple of examples that'll hopefully, spell it out a little bit better and show you kind of how we figure out approved revenue and some premium and subsidies and how that diversification impacts those things and see some actual numbers. There are just a couple of farms I made up to make it, some apples to apples comparisons. So if I kind of go through something here, I may just say, I'm going to tell you I'll talk about it at the end because it's kind of easier just to show it. But to start, what does whole farm revenue protection cover? Basically, it's going to cover revenue from all your commodities you produce on your farm, including the animals and animal products, and even commodities purchased for resale, up to that 50% limit. The only commodities really that wouldn't be eligible for this would be things like timber and forest products, or your animals for sport or show or pets. The policy also provides some replant coverage with the insurance company's approval on that. Some of the features of whole farm are there's coverage levels ranging from 50 to 85% in the 5% increments. There are some qualifications to meet those highest levels of 80 and 85% coverage, which we'll talk about. There is no catastrophic level of whole farm available. One of the big things about this policy, though, is that it's going to ensure, all your farm revenue under this one policy. So it's not going to look at just individual commodity losses. It's all going to be grouped together. And one other unique feature of this is it is the first crop insurance product available nationwide. So that means, every state, every county, this policy is available. And that's the first time that's happened with one of these. So does diversification on my farm matter for whole farm? And I wouldn't ask if the answer was a yes. And it's going to impact the policy in a number of ways. Before I get into that, I should probably talk about, what do we mean by diversification? How are we defining that? And we use what's called a commodity count. And the commodity count is basically going to be a calculation based on the commodities you produce. It's not just a simple count of commodities. We'll see when we get to the end, there is a difference between number of commodities and commodity count. So each commodity must provide a calculated percentage of the expected farm revenue to be counted. Put that into a simple example. Say we have an operation, basically, go back to count for that. It's going to be 1/3 of, for lack of a better term, perfect diversification is going to be that minimum qualification amount for one of these commodities to be counted. So say an operation has 3 commodities, they're producing $90,000 in revenue. The perfect diversification, if you will, would be $30,000 of revenue per commodity. To qualify, each commodity would be 1/3 of that perfect diversification amount, so it would be $10,000. So that's the minimum amount of revenue for a commodity to count in this scenario. And if you have, say you have a multiple commodities and you have multiple smaller ones, those can be grouped together and added up to increase your commodity count. You can add those totals and increase it that way. So, like I said, it impacts the policy in many ways. One way right away would be eligibility. So while operations producing only one commodity, or even with a commodity count of one, which is where the bulk of your revenue is coming from one commodity, and maybe you have some smaller ones, but your commodity count is still one. For potato farms, you must have at least 2 commodities. That's just based on the Federal Crop Insurance Act law. It limits potato revenue insurance to that on a whole farm basis. The other limit would be if you have commodity count of 1 with something that has a revenue policy available for it, you would not be eligible. You have to have at least 2 commodities in that case. And as mentioned, the eligibility for the 80 to 85% coverage levels would require a commodity count of at least 3. Another area that the commodity count is going to impact is going to be the premium subsidy. So with a commodity count of 1, you can see you're getting just the basic subsidy. When you get up to at least 2 commodities, you get what's called the whole farm subsidy. And you can see here, that's going to be 80% subsidy levels all the way up to 75% coverage. And the minimum here, when you get 3 commodities, 80% again up to 75%, and then it drops down a little bit for those higher levels, but where you're eligible there. There is also, I don't have it on here, but another way that the diversification is going to impact is going to be on your premium rate. There is something called the diversification discount, and as you get that commodity count up and have a much more diversity in your operation, it'll reduce that rate, and that's true up to a commodity count of 7. If you start getting above that, it's not going to impact it at all, but the more you get from 2, 3, all the way up to 7, will reduce that rate. Some of the limits for qualification. One limit is the whole farm policy is only going to cover up to $8.5 million of insured revenue. It should say insured revenue here. And this table here is kind of showing you an example of that. So, somebody at the 85% coverage level can have a maximum approved revenue of $10 million. You could have up to $17 million in total revenue, but you'll be at the 50% coverage level. You'd be limited to that. Another limitation is $1 million in expected revenue from either animals and animal products or greenhouse nursery. And this is different than the $8.5 million because this is referring to actual total revenue. So this is not going to take into account the coverage level like the overall revenue does. Anything above that would not be eligible for the whole farm policy. So how do we determine the insured revenue amount? And we'll see a little bit more how this works in the examples, but we're basically going to be looking at your current year, what you expect to produce, and that's going to be based on your farm plan that you're going to fill out when you apply for the policy, and it's going to be compared to your historic revenue, which is going to be based on your tax records, and that can be adjusted for growth. So what it's going to really do is look at based on your tax record, so your historic amount, and if it shows there's you're growing and increasing in revenue, there is a calculation for that. It's called an indexing. There's also something called expanded operations. But we're going to take those amounts, get a number, compare these two, and then your approved revenue is going to be the lower of these two amounts, and your insured revenue would be that approved revenue times your coverage level. So, how does whole farm work with other federal crop insurance policies? You can purchase other federal crop insurance policies to cover some of your individual commodities, but it must be at a buy-up level. If you do have anything at cat level, the farm wouldn't be eligible for whole farm. The way that's going to impact whole farm is that any indemnities you receive from those policies is going to count as revenue earned under whole farm. So you won't be collecting indemnities from both policies. What that's going to do, though, is with reducing that risk by having that other policy covering some of your risk, it will lower your premium. So when we're looking to calculate your premium amount, it's going to take that liability amount from your other coverage and subtract that from your whole farm liability amount up to 50% of your total insured revenue. And then the premium is going to be based on that. And that's for the premium calculation only. The liability would still remain the same. So if you're interested in whole farm, what information is necessary? And this slide is by far from being an exhaustive list, but I just wanted to get some of the basics up here. You need 5 years of farm tax forms. So basically, typically your Schedule Fs. For 2017, you're actually going to need 2011 through 2015. 2016 would be what we consider a lag year. So really, you need to have 6 years. You're going to have those 5 years of tax forms plus the lag year. There are some exceptions to this. And that would be if you're a beginning farmer or rancher, as defined by IRMA, you will not need a total of 5 years. It would be, I think it's 3 years plus the lag year you would have to have. Another exception would be if a person was physically unable to farm. So examples of that would be, they're deployed overseas in the military for a year or had a serious ailment. If you can, show that to the company and provide justification why you missed a year, then you could get away with the 4 instead of the 5 years. But that's only good for the 1 year, one time. And then also talks about qualifying persons not required to file a tax return, like a tribal entity. They would have to have alternative forms equivalent to the tax form that could be third-party verified. But if they don't actually have the tax forms, they could still be eligible. You're going to want to make sure you have all your information about what you plan to produce on the farm. That's going to be used to complete your intended farm operation report. And that's how we're going to determine your current year's expected revenue. And we'll look at that a little bit. Some of the other things, bring some supporting records. If you're, when you're doing that intended farm operation report, we're going to be talking about how much you expect to produce, price you expect to receive. You may need to bring some things to show, hey, this is the price I expect to receive. This is where I get it from. This is how I got it. This is what we've got in the past. Organic certification, things like that. You also want to, if you have other insurance, bring that information with you. Like I said, that's just some of the more important things. There's probably going to be more out there you'll need once you get into it, depending on what you're producing. So what would cause a loss payment under whole farm? Well, this is going to be natural causes of loss, as would be like with your MPCI things. Before a loss payment can be made, though, taxes must be filed for that year. And that's so, for 2017, you have a loss during this year. The indemnity payment's not going to occur until after those 2017 taxes are filed. That can be a downside for some people, but it's just, since everything's based on that tax records, it's a necessity. Generally, though, what's going to cause a loss payment is when you have your revenue to count for the insurance year, so how much revenue you actually have is lower than that insured revenue or liability, then a loss payment will be made. So if your insured revenue for the year was 100,000 and your revenue to count was at 85, then your indemnity would be like 15,000. It's just that difference between those two numbers. So timeline for a whole farm policy, sales will begin upon the release of actuarial materials. What that means is basically once we have our rates determined and set and put out there, sales can begin. The last date of purchase is the sales closing date, which for our region is March 15th. That's when your intended farm operation report needs to be completed. Then your second report you're going to do is going to be what's called the revised farm operation report. It's like an acreage report. That's going to be due July 15th. Typically, could be different, for different fiscal year filers, but generally looking at July 15th. And this is what your basis for your liability, your premium, and your insured revenue is going to be. It's not going to be the intended, it's going to be what did you actually do, but the intended will give an idea of what we're looking at. And then finally, there's the third phase of this would be the final farm operation report. And this would be due either at the time of a loss determination. If there was no loss that year, that would be due by the next year's sales closing date. If you choose not to complete that final farm operation report and are going to be electing the policy again the next year, you would be limited to 65% coverage if you don't. So it's not mandatory, but there are limits if you do not complete that. And this is just kind of a little overview of these farm operation reports I'm talking about and comparing them to the MPCI. They tried to model it after that or mirror the MPCI reporting to make it easier for people to understand. So, your intended acreage report be your intended farm operation report and so on. And down here at the bottom, this perennial just basically shows the intended farm operation report and revised are typically done at the same time. So you're not typically changing what you decide to plant with those perennials. It's pretty steady from year to year, although they can be revised. So who can benefit from a whole farm? It's designed to be well suited for the highly diverse farms, those with specialty commodities, or those selling in direct markets, basically people underserved with your typical MPCI policies. It is available to all farms and ranches that qualify. As we had talked a little bit about before, there are some limits for qualification, but otherwise it is available nationwide. So now I've kind of gone over a basic overview of hopefully some of the topics with the related to the whole farm. We'll go through just an example here, kind of showing how we calculate these things and what impacts they have on the numbers people are interested in. How much does it cost and how much is a subsidy and how much are we approved for? So I have two farms that I made up here. Farm A is going to be producing red onions, white onions, carrots, some green cabbage, and some snap beans. Farm B is doing some apples, some blackberries, and some raspberries. So to determine our historic average, the whole farm historic average, and what number we're going to be using for that, we use this whole farm history report form. This is just a sample form, but I put some numbers in, made up some data, and see if I can use these arrows here. So we're going to look at all the 5 years that we talked about, get a total, and then just calculate a simple average. And this is going to be our starting point for determining our historic revenue or average amount. There's the indexing, and this number I got through using our premium calculator, which I will go through a little bit later too. But basically, I'm not going to try to explain, because I probably can't, how that number came to be exactly, but essentially it's going to be looking at your year over year change. So it's going to take 2012 minus 2011 and I think it's divided by 2011 and 13 by 12 and so forth. And it's going to take those numbers, add them up, take them to some power, and that's going to give you this 1.134 indexing factor. When we multiply our simple average by this factor, we get a number of $107,957. We also have what's called the expanded operation. So this historic number is going to come from 3 different ones, and we're going to look at the highest here. For this example, I did not do an expanded operation, but what an expanded operation total would say you have somebody who's adding production capacity or increasing the use of their existing production capacity. So say you started double cropping, or maybe the operation has just begun certified organic and they expect to receive a premium on their prices from this year compared to the last 5. You can provide that information to the insurance company. They will look through it, and if they'll come to a certain percentage of increase, and that can range anywhere up to a 35% increase. Like I said, it's going to be based on the data you provide. They're going to look at it and justify the amount. So this could be up to 35% higher than this simple average here. In our example here, like I said, we take the highest number, which is our indexed, $107,957. This is what we're going to use for our whole farm historic average. That will be compared to our current number, which we're going to go through now. So here's just a sample form of the farm operation report. Took this from one of our handbooks. Not all of them are exactly like this, but gives you an idea of what we're going to be doing and what you're going to need to complete this. Here's the intended, you got your revised, your final. I zoomed in a little and just kind of did my own so that I don't put some tiny numbers in there that are hard to see. But we're going to go through and calculate our total expected revenue using the intended farm operation report for Farm A. It's going to, on each line, we're going to go through each of our commodities that we're producing and determine how much they expect to produce, a price, and get then a total expected revenue for each commodity. So we see here we got red onions, and next to red onions, you see a number here, 0013. And that is going to be your commodity code number. And these commodity code numbers are all listed in the actuarial documents. It's a pretty long list of commodities. It's something that we do constantly update. But this 0013 actually represents onions. So red onion is going to fall under the onion category in this example. We're determining it by number of acres. They're expecting to produce 4,500 pounds per acre of the red onions. The expected value is they expect to get $1.50 per pound for a total expected revenue per acre of $6,750. Plan to produce 3 acres of red onions. They have 100% share. So their total expected revenue for the red onion is going to be $20,250. We look down at the white onion. You can see the 0013 again under the same commodity code, and producing the total expected revenue doing the same way. If we look down here under green cabbage, I chose this one because there is not cabbage commodity code listed in the actuarial documents for this. So I use the commodity code 0325, which is other vegetables, non-irrigated. So if you have a number of commodities that aren't listed here, they could all end up being grouped under this 0325, which is only going to count for the one commodity in our commodity count. So going through calculating all this, we get a total expected revenue of $102,750 when we combine all these. We're going to compare that to the historic average, which was $107,957. And in this case, we're going to take the lower of the two, and that is going to be our expected revenue, which is $102,750. That is going to be the number that the approved revenue will be based on. So we look at our commodity count. Now we have number of commodities for this farm is 4. We recall that the red onions, the white onions were under the same commodity code. So we had onions, the carrots, cabbage, which was other, and what did I have? Whatever the fifth one was, snap beans. So we're going to look at, okay, what's the minimum qualifying amount? This is where that example I talked about the quote-unquote perfect diversification amount and taking 1/3 of that. I get this number of 8,528. That's based on this 4 commodity count. You can see we look at the total revenue for each of these commodities. They all exceed that amount, so our commodity count is going to be 4. This farm will be eligible for the whole farm subsidy as well as the 80 to 85% coverage levels. Now we'll look at Farm B. And you'll notice that this whole farm history report looks pretty familiar. I just use the exact same numbers because I want to do an apples to apples comparison and see when we get into it what the difference is going to be. And we'll see when we get into this intended farm operation report. Now, they have 3 different varieties of apples for fresh market. So all 3 of these, because the varieties do not have separate commodity codes, are all going to fall under the 0853 commodity code, and they will be grouped together as one commodity. See the black, they have a small amount of blackberries and raspberries, about a ½ acre each, small amounts of revenue here. Again, total revenue is going to come to $102,750 magically. And again, that's going to be our approved revenue for this. So Farm B, we'll look at their commodity count. They had a total of three commodities. Again, all the apple varieties are under the same code. So we have the apples, the blackberries, the raspberries. Uh, so the minimum qualifying amount here, because it's based on three commodities instead of four, is going to be slightly higher. We see it's 11,405. The apples easily exceed that, but the blackberries and the raspberries both fall short. Now, if the blackberries and raspberries total revenue combined exceeded that 11,405 amount, our commodity count would actually be two. You can group those together. Um, and for operations that have multiple commodities and they have multiple that fall under that, not get too confusing, but basically you sum all of that revenue of all the commodities that don't meet the minimum threshold, and you're going to take that sum, you'll divide it by this minimum qualifying amount, and you'll just round that down to the whole number. So basically, if you had a whole bunch, they came to combined, you had 10 different minor commodities, they totaled $30,000, divide that by 11,405, you get 2 point something, whatever, so you'd get two additional commodities. But in this case, the two don't, we have one commodity. They are eligible because there is no revenue policy for apples. This is a situation where if there was a revenue policy for apples, they would not qualify. But they're only going to be eligible for the basic subsidy, and they will not qualify for the 80 to 85% coverage level. So now I'm going to go out. I went out and determine, we're going to look at the liability amounts and then the premium and the subsidy totals. And I used the cost estimator, which you can find on the RMA website. It's under the quick links box. It's 3 down. And it will do, if you put all this in, it will calculate this all out for you. So here's a little side-by-side comparison of our two farms. Farm A with the 4 commodities. If we want to compare the two, we'll look at, say, the 75% coverage level. The liabilities, obviously, we did that all the same, so the liabilities are the same. But your total premium amount for the farm with the 4 commodities is going to be $5,626, whereas you can see the total premium for the 1 commodity farm, $15,104. So the producer's share of that premium, they have the 80% subsidy amount. So their total premium for the producer would be $1,125 for the farm A, whereas down here, the subsidy amount is lower, and obviously the premium amount is going to be higher. The producer premium amount for this farm for the same amount of liability is going to be $6,797. The subsidy amount for farm B, you can see, is a little bit higher, but the premium amount is 3 times higher for farm B. The subsidy amount is only 2 times higher. So this is just kind of a side-by-side comparison and talking about just pulling it all together and how that diversification matters and how it impacts whole farm, and just some data that shows whether how to get to it and how to calculate it and what it looks like to see if maybe this is something that would work for your operation. If you are interested in learning a little bit more about whole farm, again, on our website, rma.usda.gov, if you look on the lower right corner, there's a link there for whole farm, and that's going to link you to all of our documentation we have in terms of policy things, handbooks. There's some producer testimonials, some fact sheets, frequently asked questions, things like that. I am also available to answer questions people have on whole farm, including now. So I don't know, it looks like, I don't know if Andy's on yet, but that's all I have for whole farm. I can take questions now, or
Great.
we're still waiting for Andy.
Yeah. Thank you, Craig. Yeah, it's looking like Andy probably didn't sort out his internet problem out in Grinnell with Windstream. So he said he'll, tune in and deliver his presentation at a future date if he wasn't able to log in. So
Okay.
so for now, then, Craig had a lot of content in his presentation. If there's any questions for him, please go ahead and get them in the chat box. That was a lot of information covered pretty quickly, so there's got to be some questions out
Yeah.
there about whole farm revenue. Um, yeah, Craig, I was curious. So, when you were going through the example for B, that minimum qualifying amount was 11,000 something per commodity.
Yep.
Was that the same for Farm A as well? If not, how was that calculated? Why was that different? Or was that the same?
Right. So No, you're right. It is different. It's going to be a little higher because you're going to be looking at, it's going to be based on the number of commodities. So,
Ah,
B had the three commodities because the apples were all grouped into one. And you're going to take that total revenue amount divided by number of commodities. So for Farm A, we're dividing by four. For Farm B, we're dividing by three. And then you're taking a third of that. So with the lower denominator in that, with the three, it's going to be a higher number.
yep, gotcha. So you did say then if you had other commodities that did not add up to that minimum qualifying amount, but if they totaled together, if you lumped them together as one, that could work. Is that right?
That is
There's
correct. Yep. It's
okay, yeah.
yeah, so for those that don't meet the threshold, like I said, in this example for Farm B, if blackberries and raspberries combined, each individually were less than that 11,405, but combined were over it, you would actually end up with a commodity count of two.
Okay.
It's, just trying to look at the level of diversification. So, if you have a ton of minor commodities, they're not making up a very small percentage of your total revenue. It's not really as you're not really diversifying your risk quite as much. But if you have a bunch of different things and they're totaling, summing up to a total, that's going to help take away that risk. Then it will count that.
Right. Yep. So basically the idea, if you had other crops that were like the blackberries and raspberries here around $2,000 each that were all separate commodities, then that's going to first of all decrease that minimum qualifying amount, right? So then you might not need to lump them together to as
That's
many
also
together
true. Yeah.
to reach that. Okay.
Yes, correct. I
Well,
see a question,
yeah, it looks like
Tom.
Tom. Yeah, we didn't really mention anything about livestock. Is there anything you can say about livestock?
Uh, Yeah, no, livestock and livestock products or whatever are eligible. There is just that $1 million total revenue limit. So if you're expecting to produce over $1 million in total revenue from animals or animal products, then it would not qualify. But anything under that, it would qualify for a whole farm.
Great. Still got plenty of time for other questions, folks, if you got some other stuff here. Yeah, Craig, I guess on the subject of livestock then, what if, for instance, I mean, livestock, would those be grouped separately according to the different enterprises within livestock, according to different, species of animals and different farm products, or do you know how those are split up?
It it would. You'd have to check, the actuarials to see like the actual commodity code. I'll look up a county and give you just kind of a list of different ones. But yeah, I mean, there's probably going to be a commodity code for hogs and a commodity code for, um, beef or for, say milk or whatever. It kind of depends. It can vary in different counties on what the commodity codes are. But yes, it's not one umbrella commodity code of just livestock or livestock products. Does that answer your question?
Yeah, yep, that does. And then I'd probably expect something separate for eggs as opposed to, eggs and then poultry as far as broilers or birds or, meat birds.
Yeah, I would. Yes. And some of these, if they're not in there, may just fall under the other products, so they will be covered. But yes, I mean, something like that would be different commodities.
Well, yeah, for those of you who tuned in, I was just going to say that Andy said he will. I've got his PowerPoint and it's I can tell you it covers a lot of different stuff on the way that they basically without insurance, you know, mitigate the risks on their farm from drought, from market, changes, from flooding, from other weather and environmental events. And so he said he'll, get this presentation done for us at some point. So um, whether that is live, I can give everybody an email if you want to give me your email, I can give you a heads up when he's going to do it, or we can just have him record it and I'll put it in our archives right here next to Craig's presentation. So sorry to everybody who wanted to listen to Andy, but technical difficulties, there's not much we can do with that. But I'm not seeing any other questions in the chat box, so I guess
No.
unless anybody has a burning question they haven't put in there, we can just wrap this up for the night. Craig, anything else?